Welcome back, everyone, to the Audacious Witch channel, where we talk about the magic behind the stock market. This is the Trade Desk, ticker TTD. Year to date, it's down a whopping 62%. It is without a doubt one of the most beaten down, most hated S&P 500 stocks of 2025. At the same time, the S&P 500 is up 13%. Yikes. So why on earth, when everyone else is escaping, am I talking about buying it? Why am I willing to bet on a $21 billion company that's in a direct street fight with Google and Amazon, two mega beasts with a combined market cap of over $5 trillion? It's like jumping into the ocean with great white sharks. High risk, absolutely. But the reward? Well, that's where we're going to break down. Stick with me, because today I'm showing you why I believe Wall Street has this one completely wrong, and why buying when there's blood in the streets is how you find incredible opportunities. Let's get into it. Why did TTD get hammered? All right, so to understand the opportunity, you first have to understand the panic. What caused this massive 50% drop? It all goes back to their Q2 earnings report in August. On the surface, things look pretty good. Revenue is up 19% year over year, beating expectations. They have this amazing new platform called Kokai, and 75% of all their client money is already running through it. Clients using Kokai are actually spending 20% more because it's working so well. CTV is still their fastest growing channel. Sounds great, right? Wrong. The market completely ignored all of that and fixated on one thing: forward guidance. Management said for the next quarter, Q3, they expected revenue growth to slow down to around 14%, and Wall Street heard that and collectively lost its mind. Analysts immediately downgraded the stock, saying its growth was slowing, while competitors like Meta and Google were looking strong. The fear was simple: if the trade desk is slowing down, it must be losing market share to the big boys. But to really understand if that fear is justified, you need to understand the battlefield. We're talking about the world of DSPs, or demand-side platforms. Think of it as a stock market for digital ads. And in this market, there are three main sharks in the water: the DSP showdown, TTD versus Amazon versus Google. This is the core of the issue. Let's break down each contender, their strengths, their weaknesses, and maybe, most importantly, their clients. Contender number one, Google DV360, the king. First up, Google's Display and Video 360 with a massive 47% market share. They are the undisputed king. Their power comes from their massive ecosystem. If you want to buy ads on YouTube, you're using their tools. It's integrated with everything Google. Strength, unmatched scale, and integration. They have a huge inventory, and their platform works seamlessly with other Google products.
At Samsung, we really want to work with advertisers in a way that is best for them. So we allow them to access our inventory both direct through a managed service as well as programmatically. And we don't distinguish between the inventory. Everything's available everywhere. As an industry, it's really important for us to have more standardization in measurement. Today, if we think about how things are measured, it's very much in silos. So as a brand, it's really hard to know the effectiveness of your media, where to invest. But I do think that over the next few years, that'll start to accelerate and get to us to a state where we can have a common currency, common methodology to measure. The first reason to buy Samsung TV Plus inventory through Display and Video 360 is the scale. The second reason is we have broadcast quality, brand safe, and premium inventory. And then finally, if you buy Samsung TV Plus inventory through a deal on Display and Video 360, you're able to access our proprietary data.
Weakness, they're a mature giant. Their growth rate is the slowest of the three at 13%. They're like a massive battleship, Powerful, but not nimble. Client base, they have an absolutely stellar client list. We're talking global titans like Adidas, L'Oreal, Ford, and Samsung. These are blue chip companies that spend enormous amounts on advertising. Contender number 2, Amazon DSP, the challenger. Next up is one everyone is terrified of right now, Amazon DSP. They rocketed up to 20% market share and are growing the fastest at a blistering 22%. Their secret weapon is obvious: strength. First-party data. Amazon knows what you buy, what you look at, everything. For advertisers,
Smoothies.
This is the plan. Amazon ads.
Hey, look, it's Gina.
Come join the rodeo.
Well, congrats, sis. You won.
Gain the edge with Amazon ads.
especially consumer brands, their data is pure gold. They're also making aggressive partnership deals with companies like Roku and Netflix. Weakness: they are fundamentally biased. Amazon's DSP is designed to do one thing above all else: sell more stuff on Amazon and more ads on Prime Video. It's a walled garden, powerful on the inside, but its main goal isn't to serve the open internet. Client-based, as you'd expect, their client-based is a who's who of consumer goods: Johnson & Johnson, PepsiCo, Nestle, and General Motors. Companies that want to move products directly lean heavily on Amazon's platform. Contender number 3, the Trade Desk, the largest independent pure play. And that brings us to our company. The Trade Desk. They're sitting at 19% market share, growing at a healthy 19%. They can't compete with Google scale or Amazon's retail data. So how do they survive? Their number one strength is objectivity. They don't own websites. They don't own streaming services. Their only job is to get their client the best possible result anywhere on the open internet. They don't grade their own homework. Their second strength is innovation, with their UID2 platform solving the cookieless identity crisis. Weakness: their size. They are a pure-play software company going up against two of the largest, most powerful corporations in human history. That's a massive risk. Client-based. This is the crucial part. Look at their clients: Walmart, Coca-Cola, Toyota, McDonald's. Why would a company like Walmart, Amazon's biggest retail competitor, ever use Amazon's DSP? They wouldn't. Why would a global brand like Coca-Cola, which sells everywhere, want to be locked into one ecosystem? They want the whole internet. So who has a better client base? Google has sheer volume of legacy giants. Amazon has consumer product titans locked down. But the Trade Desk has cornered a specific and incredibly valuable market: premier global brands that demand an unbiased partner for the open internet. They aren't choosing TTD because it's the biggest. They're choosing it because it's most objective. And in a complex digital world, that objectivity is their killer feature. And that brings us to the main villain of our story. For years, TTD has been the king of the open internet. They don't own the websites or the TV channels. They just provide the best software to buy ads on them. They're objective. But now Amazon is getting very serious about its own DSP, and they're making moves. First, Amazon partnered with Roku. This gives advertisers access to a mind-boggling 80 million US households through apps like Prime Video, the Roku channel, Disney Plus, you name it. Then just last week, Netflix, who is also partner of the Trade Desk, announced they're teaming up with Amazon too. So now advertisers can buy Netflix ads using Amazon's platform. The market saw this and panicked again, thinking Amazon is just elbowing its way in and stealing all of TTD's key partners. So analysts downgraded the stock and slashed their price target to $50. And here's the kicker: Amazon is reportedly offering lower fees. Some advertisers are saying it's just cheaper to run a campaign on Amazon's DSP than on the Trade Desk. So you have a $1 trillion giant with huge partnerships undercutting you on price. See why everyone is so scared? TTD's secret weapon and why Amazon isn't the boogeyman. Okay, that's the scary story. Now let me tell you the other side of it. The side of the market seems to be ignoring. The CEO of the Trade Desk, Jeff Green, was asked about this directly, and his answer was brilliant. He said, "We're not even playing the same game as Amazon." Think about it. Amazon's main goal is to sell ads on its own stuff, sponsored listings on its retail site, and ads on Prime Video. They are fundamentally biased. They will always prioritize their own inventory. Jeff's green point is that a massive global brand like Coca-Cola or Toyota doesn't want a biased agent. They want an objective platform that will find them the cheapest, most effective ad space anywhere on the entire open internet. Not just on the properties Amazon owns. This is TTD's superpower. Objectivity. As Jeff says, we don't have any media and we don't grade our own homework. They aren't conflicted. Their other secret weapon is something called Unified ID 2.0. This is super important. With Google getting rid of third-party cookies, advertisers are freaking out about how to track users and make sure their ads are effective. UID2 is TTD's solution. It's an open source identity framework that's more transparent and respects user privacy. It's the future of identity on the open internet, and TTD is leading the charge. Amazon's system is a walled garden. TTD is not. So while the market sees a price war, what's really happening is a value war. Amazon is competing on price. The Trade Desk is competing on precision, identity, and most importantly, outcomes. The price is wrong. That's a gift. So what does this all mean for the stock price? This is where, as an investor, I get really excited. Because of all this fear, the stock has gone, in my opinion, incredibly cheap. A price-to-sales ratio of 8 for a high gross margin, Palantir-like growth stock is a steal. Once the economy turns back around and Kokai reached 100% of clients, revenue growth will be back and TTD will fly us to the moon faster than Bezos' Blue Origin's rockets. What's my plan? Look, I'm an audacious investor. I like buying when things look scary. Everyone thought Intel was dead, losing billions every quarter, and that stock is up almost 50% this year, even outperforming Nvidia. Buying stocks like the Trade Desk or Lululemon right now, when they are so hated, is the definition of buying when blood is in the street. It doesn't mean the pain is over. The stock could absolutely volatile and maybe even go lower in the short term, especially until the company proves its growth can reaccelerate. But from a risk-reward perspective, I find it incredibly attractive right now. I already own shares, and I am not selling a single one of them. And I'm waiting patiently for signs that the stock is finding a bottom. Once I see that, I plan to increase my positions. I'm betting that the market has overreacted and created a fantastic opportunity for long-term investors. Now, I want to hear from you. What do you think? Is TTD a falling knife or golden opportunity? Are you brave enough to swim with the sharks on this one? Let me know your thoughts in the comments below. And if you got any value from this breakdown, please hit the like button and subscribe for more real talk. Thank you for watching, and I'll see you in the next one.